Well, good morning, everyone. Thank you for being here. Uh, we're at the Q3 2022 Economic Update and Investment Outlook. We appreciate you joining us today. We have a great participation. Our usual diverse international group is with us. Thank you, folks, for being here from the other side of the pond. We hope to give you a general overview of the key issues impacting the U.S. and the global economies. We're focusing on areas that will impact most of our attendees. Please note your questions in the chat box. There will be ample opportunity in the latter part of the presentation to answer them. Several of you have already submitted questions in advance. We'll address those when we begin the question portion of the presentation or cover them to some degree during the presentation. So let us explore a quarter of continued growth, change, and probably the biggest uncertainty. When we had our Q2 economic update 3 months ago, the U.S. economy was beginning to slow down. And inflation was accelerating, and we had 2 quarters of negative GDP, and we had a new item to keep our eye on, the recession. That's a technical definition. I'll talk more about GDP and recessions in a little bit. And of course, we had the big I, inflation. We had unemployment continuing to hover at all-time lows. Everywhere you went, there was a help wanted sign. Wow. We learned, I guess, that this is the new norm. Americans were longing for many of the pre-pandemic lifestyle norms they had become accustomed to. That time with family, time with friends, travel, freedom, and of course, the great American pastime, spending money. They didn't like having to pay more, but they were still spending money. In case you missed it this morning, third quarter GDP was announced as an increase, note that, an increase, growth of 2.6%. So what does all this mean? Well, helping us this morning, as we've had before this quarter, is Patrick Gauthier, Senior Portfolio Analyst with CPS Investment Advisors. And Patrick, I'm going to turn you over as the presenter.
Thank you, Marshall, and thank you everyone for joining us here this morning. And again, I'm Patrick Gauthier. I'm a Senior Portfolio Analyst with CPS Investment Advisors. Happy to be back with this group for another quarterly market update. It seems like the quarters keep coming faster and faster these days. So I'm not sure what's on everyone's minds, but I know what the market is thinking about. So we've got inflation, the Fed, and what folks expect out of the Fed. So we are going to dive right in there. And it has been a roller coaster so far this year. So we're going to take a look at a few of the things that may have gotten the market down and see what has the consumers moving forward here in the U.S. So this is a look at the third quarter, major indices in the market. Just the third quarter itself, we're looking at a roller coaster ride. So started out July from a low point. August was one of our typical bear market rallies. Looking at some positive things coming out for August, folks had hopes that inflation was going to come down quickly. There were talks of the Fed maybe slowing down their rate hikes. And it turned out the consumers were still spending money, and everyone is pretty happy when we're able to go out and have jobs and still spend money. But that ticked down a little bit for us, and we ended the quarter down from where we started pretty consistently. So when we look at the year as a whole, we look at 4 major indices, and you'll notice an important one was added there, the Bloomberg U.S. Aggregate Bond Index. And why is that important? Well, a lot of us will look at bonds as a safe haven or as a buoy for our portfolio in bad times. Well, in reality, bonds weren't a safe haven. There was no place to hide in this market. That's a similar song to the one we've sung in the past. It's been a pretty tough year all around in most asset classes. But with these bad times come good times. So if we hang on, we're feeling pretty good about where we're going moving forward. So what had the market down so far this year? The key driver is inflation. If you've had the TV on at all, inflation is the key story. So three major numbers there. Again, this is probably not a surprise to anyone on this call, but we have our headline inflation, which is running at about 8.2%. That's the one you're going to most commonly see out there talked about. Then you have your core, which is referenced as headline minus food and energy. Probably heard this one before, but I don't know too many people who go through a day without consuming food or energy. So that is used more for statistical modeling and data tracking. They don't like the way food and energy prices are volatile, so they created a measure to cancel those out. The one on the bottom is a little lesser known to the general public, but it is the Fed's favored marker of inflation. It's personal consumption expenditure. So a separate way to look at things, instead of just looking at what the actual prices are of goods in the market, personal consumption expenditure is going to be what people are actually buying. So it's a household measurement of what people are actually spending versus what they were spending in the past. And the Fed keeps a very close eye on that to try to track, where that money's going in the system, and hopefully track some of the discretion that we have as households to choose where we spend our money to some degree. We're always going to have that food and that transportation costs and that housing costs, but we get to decide if we go buy a new couch or TV or take that vacation. And this takes those types of things into consideration. So the Fed, never been more popular or unpopular, if you will, these days. But we have the Fed with some of its tools and how they're going to try to fight this inflation that we're facing. So the well-known version is the Fed funds rate, and a pretty steep incline there. We've gone from pretty low historical Fed fund rates to what you would consider more normal rates. 3.25%, and next week we're anticipating another 75 basis points. So you're going to be in the 4% range for the federal funds rate. We haven't seen that in a while in terms of the recent past, but if you go back a little further, over 30, 40, 50 years, the Fed funds rate is typically near this range or even a little bit higher. But the reason the graph is important is because this is the steepest rate of change we've experienced in the Fed's history. You got to go back to the 70s to have rates go up nearly as fast as they are now. Your typical Fed changes in the past have been a quarter basis point here and there, a quarter point, skip a meeting, do a quarter point after that, one way or the other. But now we're talking about 50, 75 basis points at a time, and you're looking at, is a full percent change out of the realm of possibility. It certainly isn't at this point, depending on how inflation keeps going. One thing to note as you watch the Fed funds rate change over time is that in fighting inflation, the Fed has never stopped raising rates until their designated rate was above the rate of inflation. So there's one of two ways this works out. Either the Fed changes its colors and they stop raising before inflation comes down, or they keep raising and inflation and the Fed funds rate meet in the middle somewhere. And we'll talk a little bit about what the market predicts from that end of things. The second tool that the Fed is using, which is unique to the Fed and unique to recent history, is quantitative tightening. I'm sure most of you have heard the term quantitative easing. That's where the Fed created cash. They created money in the system. They used that money to go out and buy bonds and assets off the open market and house them on their balance sheet. So this is a shot at the Fed's balance sheet as it stands. And you'll see where we've hit a peak and started to have the balance sheet shrink, if you will. And that's the tightening aspect from the Fed. So there's two ways that the Fed tightens the money supply. They let their bonds mature. They let their securities mature and they collect the cash that they're owed. And that's called rolling off. just like you and I may go buy CDs or bonds that mature at a future date. It's exactly what the Fed did. Some of those securities are starting to mature, and they're simply choosing not to take that cash and go out and purchase more assets with it. So that's more of a glide path, if you will, with the Fed letting assets roll off their balance sheet. The more aggressive take is a sell-off. That's where they look at their balance sheet and they actively go out on the market and sell the assets that they own. And they're starting to do that now on top of the roll-off. So depending on the assets that you own, you may or may not get full price when you go to sell them. But that is a more effective way of pulling money out of the financial system and putting it on the Fed's balance sheet. So really, when you think of tightening and you think of roll off or sell off, just know that it's the opposite of easing. Easing was pumping money into the system. Tightening is taking that money back out of the system. And the intent is for the money leaving the system to make it harder, less liquid for companies and for banks, and therefore for consumers to, fund a business or borrow for a home improvement, or, as Marshall's going to touch on, borrow for buying a home these days. So those are the Fed's main maneuvers, if you will, on how they want to shrink inflation and how they want to affect consumer demand. Is it working? Well, that's certainly up for debate, but a couple of the key indicators are not necessarily in the Fed's favor at the moment. So on the left, we have the U.S. unemployment rate. This is a bit counterintuitive because if we looked at unemployment at 3.5%, most of us would feel pretty good about that. If you have a job, you're likely going to get a raise so you don't leave it. Or if you're looking for a job, you're likely going to be able to switch jobs and go get more money somewhere else. When the market is tight like this from the employment side of things, it's good to be an employee. You have some pricing power and you have some options. Where that's bad for the Fed is that means you have money in your pocket, and those who are willing are able to go out and get more money. And when you have more money in your pocket, as consumers on the right here, we are going to go spend it. As Marshall said, it's one of America's favorite pastimes. We don't like to hang on to our money, in the majority of us. So employment is counterintuitive. The fact that folks are out there still spending their money, and the only way to get them to stop is to reduce their prospects for future employment. That can come in two forms. We can start to reduce the number of job openings, which is happening. You saw a pretty big number recently of job openings going away. It was in the million jobs range, which you would think is a bad thing, but for the way the Fed wants things to go, that it's good to see that those jobs are either filled or off the market at this point. However, even with that many jobs leaving the market, we still have more jobs available than we have people that can fill them as far as the labor force. So there's some work to do from the Fed on that end of things when it talks to bringing demand down and getting money out of people's pockets. So I want to talk a little bit about the market. We're looking here at S&P earnings versus earnings estimates. So what you've seen over the course of the last couple of quarters is companies and management are coming out and saying, we expect to earn less in the future quarters than we originally thought we would. So they are lowering their earnings estimates moving forward. Is that a bad thing? In some cases it can be, but when you zoom out and take a look at earnings, you'll see where these two graphs coincide, the orange and the blue. The S&P does a pretty good job at estimating its earnings per share. Rarely is the S&P as a whole going to far exceed their estimates in earnings per share. You will get those single companies that do that over time, and that's where they get pretty good bumps in their share prices. But as a whole, they're pretty good at estimating those earnings. So when we look at forward earnings estimates, we can see that even if they lower those earnings estimates, they are still anticipating making more money than they have in the past. Remember, those earnings estimates are talking about growth rates. So they're saying we started at a certain point and we expected to grow 10%. We're now lowering those earnings estimates maybe to 6 or 7%. And if they hit those lowered earnings estimates, you can see by the blue line at the top, they're still all-time high earnings, which is a good thing. We'll take positive earnings growth. We'll take all-time highs anytime we can get them. It just means that maybe the growth that they thought they were going to get at the beginning of the year is going to end up being a little bit less. So don't take those headlines as a negative. Companies are still expecting their earnings to grow and have all-time highs, just not at the rate that they've grown in the past. And we've seen this illustrated recently, the last week or two with earnings reports. Companies that are still able to surpass their lowered bar of earnings are being rewarded. Their shares are going up. And when you look at companies that haven't hit those estimates, the market is taking that into consideration, and they're paying a price in terms of share price. If you lower your earnings estimate and you're not able to hit that lowered estimate, you're going to pay the price these days. The market wants to see that you're still capable of going out and driving earnings growth. We'll look at Facebook as a prime example. You want to make sure you can still hit your earnings estimates, whether they're high or low. So what are we expecting? So on the left, you see the market's expectations for Fed funds rates for next week. High level of certainty that we're going to have 75 basis points rate increase next week. As GDP came out today, Marshall's going to touch on that. We'll see what the projections are for the December meeting, but most had that in the range of 50, and you're probably more likely to see 75 at this point again in December, with GDP increasing. On the right is an interesting chart that you don't see often. They call this a dot plot, and this is the survey of the Federal Open Market Committee's participants' projection of rates. That's a mouthful there, but basically it's the committee's version of where they think rates will be over the coming years. The best way to look at a chart like this is to look at how concentrated those dots are. So we've got a lot of consensus that rates are going to be 4 to 4.5 by the end of this year, and we're going to see that here with rate hikes next week. When we get to 2023, there's still a pretty good consensus that rates are going to remain lower than 5%. So that's the participants saying, we feel like there might be another hike or two, but that may be the peak. The Fed may get what they want in terms of demand coming down and inflation slowing, and they may not need to raise rates beyond that. Then in 2024, you start to see that consensus break a little bit. You get a little wider dispersion of opinions on where rates will have to be in 2024. So that's the case, generally speaking, when you get a couple years out. Even the Fed doesn't have a crystal ball. They're not going to know exactly what's going to happen in the economy. But the participants are showing a bit more consensus there that they think the Fed may have to bring rates back down some point towards the end of 2023 or early 2024, because they feel that the Fed is going to go far enough to kick the economy into recession, and that's going to cause them to have to reverse course to some degree to spur the economy again. So interesting to see how those numbers start to change moving forward as more and more GDP reports come out. But an interesting chart to see nonetheless. As always, here at CPS, we're going to look at companies that consistently grow their earnings, consistently pay dividends, consistently manage their capital structures. They're sound financially, and for the most part, they provide goods and services that the economy needs in good times and bad times. So we'll quote Warren Buffett to wrap things up. Be greedy when others are fearful. When you look back at those charts of the major indices being down 20, 25, 30% for a year, translate that to fear. That is uncertainty in the market. Folks don't know exactly what's going to happen in the short term. That's fear built into the market. Now is a great time to be greedy when others are fearful. You're buying great companies at a discount to what you've paid for them in years past. And as long as the American economy keeps chugging along, those companies are going to remain valuable for a long, long time. So again, I appreciate everyone's time. I will stick around to help out with any questions, but Marshall, we'll turn it back over to you.
All right. Thank you, Pat. Appreciate it as always. And, your insight is just so helpful to us every time. So we really appreciate you giving us some insight, looking at the Fed, looking at the market. And so we'll drill down a little bit more on the economic update, and we will see what is exciting out there. Let's look at what we've got going into the fourth quarter. Of course, to recap a little bit, inflation's high, geopolitical tensions are getting higher. Boy, if you could have bought geopolitical tension futures a few months ago, that would have been pretty good. That's been rising fairly steadily. Interest rates still low, but moving up. There was a time when we said, okay, the Fed's going to target 4.25, 4.5% on the Fed's funds rate. We would have thought, oh my gosh, that's phenomenal. Now we look at that and go, oh my gosh, what are they thinking? But the reality is that times shift around, and that's important that we recognize the relative nature of those particular changes that we see in interest rates. Unemployment, I think the new unemployment filings came out this morning, about 217,000, right on target, staying fairly constant. So the changes that the Feds have made haven't given us a great deal of change in that particular area. Demand still high. Consumer demand, because the cash is still up there, but it has begun to wane a little bit, especially in the housing market. And I'll talk a little bit about that. And, it's interesting. COVID seems to be a back burner right now. We're not hearing much about it. We're hearing some shuffling going on vaccines versus not having vaccines. I'm sure as we get into the fall, a little colder weather, and the cold and flu season cranks back up, we'll hear more about COVID. But for the moment, it does seem to be on the back burner of people's thoughts and concerns. So let's look at that GDP trend. Wow. Last time I did my math, if we look at 2022 now, at down 1.4, down 0.9, that's about down 2.3, and now we're up 2.6 this quarter. So GDP for 2022 is now on the positive side. I have to admit, I didn't really think that would be the way it would turn out, but the numbers are the numbers. And to take you back, and we have to ask the question, and I was one who stepped up to the front line last quarter and said, okay, my economics professors pounded in my head, and I got the question right on the final. What's a recession? And it was 2 consecutive quarters of negative GDP. Okay, well, we had 2 consecutive quarters, so by definition, that should have been a recession. The other thing, there's the National Bureau of Economic Research, and these are the geniuses who actually turn around after the fact and go, yep, that's what it was. It was a recession. They haven't spoken yet, so we still don't know for sure that it was a recession. And then, of course, we had Secretary Yellen, who gave us Yellenomics that said we're not in a recession, we're in a transition in which growth is slowing. So you pick and choose whether you want to call those last 2 quarters a recession or not. We'll let each person identify it on their own. Chairman Powell, of course, is telling us that we are headed for a soft landing. So whatever you call it, growth slowed, which is generally a bad thing. But in this case, it's the goal of the Fed. The question is, will that growth or lack thereof, what will it be in Q4? Chairman Powell says there will be positive growth over the full year. So if we're up 2.6, having been down 2.3, that means we're up 0.3. So we've got 0.3 to play with to still be up. Remember, up 0.1 is up. So positive growth, we hope, will be a good thing, but moderated, of course, to keep the Fed from getting out of hand raising those interest rates. As Patrick mentioned, the Feds are pretty open that next week's meeting will generate a 75 basis point increase, and that there is a very good chance of another 50 basis point hike by the end of the year. So all I can tell you is stay tuned. In saying that we're headed for the soft landing, the question becomes, can the Federal Reserve monetary policy succeed? So if they go for the short-term Fed, it's misspelling. That's why I'm a CPA. I can't spell. Fed funds rate increases to 4.5%. Unemployment staying less than 5%. 5% back to economics class is considered full employment. Inflation less than 2%. They probably live with 2%, that's for sure. And positive GDP, not a recession. So we're getting close to 3 out of 4. The challenge is inflation, and to bring inflation down from 8 and change down to 2, that's quite the jump, just as going from 2 up to 8 and change or 9 didn't happen overnight, but boy, it sure hit, and it hit fast. So unfortunately, most economists do not think that the Feds can pull it off. Reason? Nobody's ever done it before. But being the internal optimist that I am, let's give them the benefit of doubt and hope that they do. So where are we in the business cycle? This is the standard business cycle. We go with the business cycle framework in the early portion where the growth is coming into play. In the midterm, you get growth peaking. The late term, okay, growth is moderating. Now, remember Pat just showed us the chart where the estimates are being revised down, but they're still up relative to prior quarters. So that's growth moderating. Credit tightens. We haven't seen credit tightening yet. The banks are still wide open to lending money. I've got a couple of bankers on the call today, and I'm guessing that they're nodding their heads at the moment. Earnings are under pressure, no question about that. With inflation, higher wages, can the corporations pass those costs on to the consumer? So there is pressure on their earnings. And as we saw last night and this morning, Meta, formerly known as Facebook, missed earnings, and boy, they got hammered for it. So if you meet your earnings, you're being rewarded with your prices going up. If you miss it, wow, the market just hammers you. The policy, Fed policy is contractionary, which is what we have just seen, and that's where we're headed. Inventories are growing, and there are a couple of things that are causing inventory growth. I'll go over those in a minute. And sales growth begins to fall. Top lines are coming down. That to me is an almost perfect description of where we are. And you can see the US blue circle in that section. We haven't seen the falling activity. We haven't seen credit drying up. We haven't seen profits overall decline. Remember, it's the estimates that are declining, not the profits. Policy easing and inventory and sales fall. So I think if we had to pick it, we're very much right on this chart as it shows in the late phase of the business cycle. Now, does that mean we're going into a recession, or will we have that soft landing and get back into the early phase of the cycle? Nobody knows, but that's the goal of the Feds. Inflation, it's on everybody's mind. You know, you see the 8.2%, and I'd love to tell you that 8.2 is tight. I'd love to show you that consumer purchases in the 4.6% range is good. I'm fairly good at math, and it just feels like when I go into the grocery store, 8.2 is not the number. And I've alluded in previous sessions about how you can get kind of surprise price inflation by the price is the same, but the size of the product has been diminished. Kind of a hidden way of passing that on. So I felt bad even showing this slide. If you don't eat or buy gas, you may not have been aware. So I don't think I have too many people that don't do either of those. So the geopolitical side, wow. The concept of a truly global economy has become even more evident since last February when Russia invaded Ukraine. The European dependency on Russian energy, food, and other products coupled with the disruption of the Ukrainian production, is choking an already shaky Eurozone economy. And they thought Brexit was bad. One of the perfect examples of the disarray is the Liz Truss 50-day term as the prime minister. On Tuesday, if you didn't see it, Prime Minister Sunak, in his opening speech, came out and described the United Kingdom as in a profound economic crisis, experiencing slow growth, high inflation, falling real wages, labor union strikes, voters demanding election. Talk about rallying the troops. That doesn't sound like a lot of fun to me. China continues to support their neighbor Russia, and of course they have threatened actions on Taiwan. North Korea shot a missile over Japan. I'm not sure what that's about. I thought their disenchantment was with South Korea, and they had their battles. They had an incident last week. So things are tense over on that side of the globe. Of course, we've got OPEC and President Biden are having a war of words because OPEC is decreasing production to charge a higher price for their oil. Last time I checked, that was free enterprise. Henry Kissinger taught them all about that. And the thing that really confuses me in that is what happened to U.S. independence on oil. I thought we were headed that way a few years back. Sorry, just went into editorial and not factual. But I'm a little confused on that one and trying to find good answers. Interest rates, what are they? 10-year treasuries about 4.3. So if a 4.3% return on your money, 10-year treasury makes good sense. 30-year mortgage rates about 7.9. Ouch. The near record high prices around the U.S. made it so difficult for first-time home buyers to compete. Interest rates have more than doubled since this time last year. And according to my realtor clients, the biggest hurdle is still supply. But the overbidding wars have subsided and the inventories are beginning to slightly increase. Demand for mortgages has fallen to its lowest level in 25 years. New mortgage applications, man, they're just dropping fast. Of course, this is in a large part to surging interest rates, according to the Mortgage Bankers Association. So they're a pretty good resource. The rate for the most popular mortgage to 30 years around that 7.9. Just a personal note, in 1977, I built the first house I had ever built, and this particular builder had 7.9% financing. I honestly thought that I was going to have to wear a mask and carry a gun to closing to get the 7.9% money, but I was thrilled to get it. Fast forward a couple of years later, we were buying a condominium in Crescent Beach, and I got an 18% first mortgage and was darn glad to get it. So the psychological side of the rates is probably more impactful than the actual monetary dollar of the rates. But the 30-year fixed hovering, getting close to 8% after starting the year around 3%. That's a rapid turnaround. And this came after several low years and easy money from the Fed, and all that has cooled down quite a bit. Americans were scooping up houses just as fast as they could. Well, not just the ownership side, but the rental demand is also drying up as high prices are pushing more people to double up or move in with relatives. Rents have risen 25% over the past 2 years, according to the rental website Apartment List. This is pushing renters beyond what they can afford. And inflation, of course, on other essentials is taking a bite out of their income. Apartment demand in the third quarter, measured by the 1-year change in occupancy, was the lowest since, wait for it, 2009, when the U.S. was feeling the effects of the subprime crisis. The apartment vacancy rate rose 5.5% in the third quarter, up from 5.1% in the second quarter. So we're seeing not just in the housing purchase, but in the rental market as well. So got to keep an eye on those as we move forward. There still seems to be a lot of rental construction, So is there rental demand? Help wanted. Seems like every client that walks in the door, and we're starting, of course, our year-end planning with everyone, and they have the same mantra: I'm looking for more good people. Interestingly enough, high inflation is forcing more Americans to consider second jobs. An interesting survey came out that about 38% of workers have looked for a second job, while an additional 14% have plans to do so. That was, as I say, a survey just a couple of weeks back. At the same time, 18% of working adults said they had moved to an area with a lower cost of living to cut expenses, and another 13 plan to do so. Well, for those of us who are in Florida, we know very well about this. We see the moving vans coming across the state line on virtually a daily basis, and we watch our population around Florida soar and the demand for our homes to be very, very strong in Florida because of, no state income tax is definitely a draw. And of course, the climate that we go through. We won't talk about Hurricane Ian, but we'll talk about the climate other than those times. So those who want to work are working, and maybe working two jobs or a day job and a gig job. There's a lot of Uber and DoorDash folks out there, so we'll see what transpires. So is the consumer confident? Well, we're seeing recovery. When you look that, yeah, it was 115 in December, dropped down in March because things weren't looking real great. June, oh my goodness, we're in the second quarter. This is a recession going on. So now here we hit September, we're back up to 108 in consumer confidence. So we're higher now than we were in March. So while the U.S. consumers say they aren't feeling great about the economy, they just have a curious way of showing it. Pessimism has been on the rise due to the surging inflation, falling household income relatively, and despite inflation's negative impact on purchasing power and the sentiment that we saw, consumer spending growth continues to be remarkably resilient. Well, why is this happening? Well, there's a real simple answer. Consumers have money. According to Wells Fargo, consumers had accumulated as much as 2.1 trillion in excess savings during the COVID period. That's a lot of extra spending power in an economy that's about 25 trillion in annual GDP. However, these savings are rapidly declining amid high inflation, and so Wells Fargo came out and estimated that the accumulated excess savings had fallen to 1.3 trillion as of August. The latest round of bank earnings shows that apprehension hasn't kept Americans from reaching for the credit card. Hey, even Social Security recipients just got an 8.7% raise. So there's money to be spent. And as I said, Americans love to spend it. So what about those leading economic indicators? Well, Conference Board tells us that December leading economic indicators were at 120, dropped down to 119. Again, end of the second quarter was not fun and games. We were down to 108, but it's bouncing back to about 115. So ordinarily, this might be considered tepid news. It's coming back. But with the Fed goal of slowing the economy, a slightly lower LEI could be a good thing. So we're going through that period where good is bad and bad is good. Good information, as we would normally look at in the economy, is bad because then the Feds are going to increase interest rates. So getting that balance for that soft landing is going to be just major to watch in the coming months. Wow. We've had several questions about, what do I do with my money now? So I'm going to address some of those things. And so we always use the slide, investing in uncertain times. And I always ask the question of, when was the last time times were certain? And here's a nice chart that I like to always throw up. There's always a reason not to buy stocks. In the words of, again, the 20th century philosopher Rosanna Dana, it's always something. If it's not one thing, it's another. But what is reality? A fellow advisor of mine, great guy, gave us this the other day, and I couldn't resist putting this up. Some of my more senior attendees on the screen today may recognize this particular caricature. For those of you who are probably under the age of 50, the gentleman is President Gerald Ford. Now, I don't know if you can make out the date, and I apologize, but if you can look in that upper right-hand corner, the date is October 14th, 1974, a mere 48 years ago. And if I could take Gerald Ford's caricature and impose Chairman Powell's picture on top of that, that would be the change, and it's different. It's different this time. It is time-wise, but the reality is the topics are still the same. The challenges of inflation, not wanting to have a recession, and of course, oil is such a driver in the U.S. economy because of the number of products that it impacts, as well as travel, and of course, the American consumer who drives a lot. And of course, that takes petroleum products. So what happens? Well, 1974 was not a great year. Those of us who are around may remember that. But look at 75 and 76. And look at the white versus the red on the 49-year average return of the S&P, which is about 12 and change. So yeah, we go through tough times. There's no question about it, but those tough times subside. As of the other day, the S&P was down about 17.5% for the year. Hopefully, I'm going to give you some hope in a few minutes as to where that might be by the end of the year. And, of course, if we don't have enough going on in the next couple of weeks, what about the election? Well, here are the facts. In every, underline every mentally there, midterm election since 1946, the sitting president's party has lost seats in Congress. So if your person gets elected 2 years later, odds are Congress is going to see a void of that particular party. Now, there is one exception, and that exception was in 2002 when the Republicans were still riding what I refer to as the patriotism wave that followed 9/11 of 2001. Keep in mind, we were one America there for a period of time, and it was a wonderful experience. Love to go back to it, but we're definitely two Americas today. A poll released this week indicated that 65% of Americans are saying the country is not, emphasis, not headed in the right direction. So if you had to ask me, am I expecting a lot of change coming on in a week from next Tuesday? Absolutely. So how do the midterm elections impact the market? Well, here's one for you. This goes back to 1962. And it appears that before every midterm election, the market doesn't do real well. There's a lot of volatility in the down direction. And then after the election, 1 year afterwards, look at their returns. Market has been up. Now, it's not once or twice, it's every single time. So I can't tell you, I don't know the future, but I'm one of those guys that if I'm sitting at the blackjack table, I understand probability. And I can tell you, probability wise, I'm saying that it should be up over the next year. So we hope that maybe we've bottomed out, but we're very positive and looking forward. So that's that. You want to notice too about how the drop is very similar to the recoveries. So we'll see what happens. The next question, of course, is begged is, well, gee, is it better if you've got a Republican president or a Democratic president? And I'm going to tell you, it just doesn't mind. It just doesn't matter. We can see each time we've had great years in the red, we've had great years with the blue, but the average of the green, and I don't think there's anyone on the screen who wouldn't take the green and be very, very happy. Excuse me. So what about the election? Well, let's go back and we'll talk about that. So I'm just going to tell you and summarize, it doesn't matter. The election relieves uncertainty. The market is volatile based on uncertainty. When the uncertainty goes away, the market gets less volatile. The key is policy, not politics. Politicians say and propose all sorts of things. We're facing another deficit ceiling battle coming up. I'm going to plant the seed. You're going to hear that coming up. You'll hear the first thing to go will be entitlements, Social Security. The vote will go through, but not after the usual wailing and gnashing of teeth that goes with the political posturing. The reality is, with everything going on in the world, the U.S. cannot default on its debt, period. And Congress will hit that realization. They'll raise the debt ceiling. So stay tuned for that. Was the market due for a correction or recession? Absolutely. Corrections are the normal part of the market's existence. Remember, I showed the business cycle earlier? That's the normal course of things. We all in our lives go through cycles of highs and lows in different aspects of our lives. So you have to realize that that's just normal. Corrections, of course, you see on the chart here in the kind of the bluer color. They are declines of 10% or more. You see the numbers for them. And then the bear markets are declines in 20. Yes, we are currently in a bear market. We're getting close to hopefully breaking back out of it. And the number of calendar days for it are in parentheses. But this again goes back to 2008. And let's just look at the overall trend. Life happens. Things go wrong. But what happens to the overall trend of the market and the U.S. economy? And the key is the U.S. consumer spends things on that they just will not give up. And we'll go back even to the big dip in 2020, which I really look at and say that was the real litmus test on what will Americans give up, because there was probably the greatest uncertainty I can recall in my lifetime, and that was COVID. We really didn't understand it, didn't know what to do, and as a result, the market froze. So yes, we're down, but for the long-term investor, obviously this is the place you want to be. Of course, you have to plan for a lifetime of income, and we've got an inflationary environment, so you have to look at two things. Will your income outlive you, or will you outlive your income? So your income off of your portfolio, off of your investments, or off of your employment has to grow at least as fast as the cost of living goes. So if we go back and we've talked about retirees taking money off of the pile, we call your investments the pile. In this case, it's a 100% equity portfolio. We go back to 1973, less is a 49-year spread. If you had $1 million, you took off 7%, that's the red line, you'd have been broke in 16 years. So if you're 100 years old already, 16 years really doesn't matter to you most likely. If you took off 6%, you're the light blue line, and it would have lasted 29 years. So at 6%, again, let's drop it back. Let's say you're 80 years old, that gets you to 109. So you probably had money left over before you went broke. But if you look at the 5% and you're only 65 years old, we can look and go, wow, look what happens over 49 years. So now you're 114, you're in good shape, obviously. But most people who are retired aren't going to go 100% equity, so they're going to look for a blend, a balanced portfolio of stocks and bonds. And as you can see, the differences out there, you buy a little more time in a balanced portfolio. So your 100-year-old could live to 120, your 80-year-old could live to 118, and of course, your 65-year-old is doing just great. So those are keys for you to understand when looking at the long-term aspect of the money. So where should I invest now? Pardon me. Well, the key is, what's your objective? Why are you investing? If you're investing for stability, because I hate volatility. Well, there's the bank of the mattress, the sock bank, the piggy bank, but with inflation, you're losing money every single day. Treasury yields, as I alluded earlier, have been in the 4% range. That beats money markets by multiples. But after taxes and inflation, you're still losing purchasing power. You can look at a balanced portfolio that gives you a mix of equities where you anticipate growth, even some dividends, and some fixed income to give you the balance because, again, like the one at the top, I hate volatility. There may be income where you're looking for high yield equities. That's always a possibility too. That's a blend, high dividends as well as potential growth. Pure growth stocks really don't do a great deal for you if you're trying to go to the grocery store because you have to sell the stock to recoup the growth that's taken place. So a big question too becomes, what's your time frame? If you're only taking out your required minimum distribution or you're not at the RMD age, your timeline may be, hey, I don't have to touch this for a few years. I can let it grow. Or let's say maybe you're saving for your grandchildren and they're not going to touch it for 10, 15, maybe 20 years from now. Well, a lot's going to happen in the market. And we know historically that if we look back to how the market performs, you would have wanted to have been in equities during that longer time frame. So things to think about. Buy companies, not headlines. We see the headlines that tell you that this company's dying, and I can scroll down the screen and I can tell you, here's another someone who says that this company is the best thing that's going. I suggest you look for companies in your credit card statement and in your checkbook. It's kind of a crazy comment. Where do you spend your money? We found out that people will not give up the cell phone. They won't stop taking their medications. I can't get onto my computer to work without certain software companies and hardware companies and vendors. And so what are those things that we as Americans virtually can't give up? That's one of the things to think through. So if your time frame is very, very short, your investing becomes totally different. If your time frame is for the long term, look for where you spend money. Look for where your family spends money. If it's just the you can find the answer in the mirror. Got some more points for you to take a look at on those, but the key is just use common sense as to what's going and watch out for the clickbait catastrophes that the internet gives us. So what happens to a diversified portfolio during inflationary periods? I love this, and it's a case of on the left-hand side, when inflation is less than 4%, what happens to a balanced portfolio 3 years, 5 years, and 10 years? And as you can see, the return when the inflation is less than 4 is a fairly decent return. You can keep ahead of inflation generally, and you have growth in your portfolio. You look on the right-hand side and you've got when inflation is greater than 4%. And of course, inflation greater than 4%, as you would anticipate in the short term, has a strong impact on the portfolio. But when you get out to the 10-year period, impact is virtually minimal. So inflation, what I want to bring you back to here, is that inflation will impact your portfolio in the short term, but staying the course with a solid balanced portfolio for the long term is the answer for the long-term investor. So, things you should be doing with your financial plan: achieve financial independence. You want that day when you go to work because you want to go to work, not that you have to go to work. Or you know that you're not outspending your money and that you will live longer, or your portfolio will live longer than you will. I was going to go live long and prosper, do a little Spock for you there. But keep an eye on your financial plan. You probably need to do some modifications. Are you taking off a proper percentage? Are you taking too much, too little? Are there uncertainties going on in your own plan? Again, start with the mirror. Keep your taxes down. I'll talk taxes for just a minute. We had the IRA Act that came out a few weeks ago now, and the impact really on individual income taxes for most taxpayers is very nominal. So the real impact on income taxes has been the increase in standard deductions, increases in the amounts you're going to be able to put into retirement plans in the coming years. So there are lots of ways to minimize your taxes because of inflation, which is kind of a crazy way of doing things, but that's the way our Internal Revenue Code is set up. So lots of planning opportunities. Be sure to do some solid year-end planning. Always take a look at those beneficiaries and make sure your documents are where you want them. I have to ask, beg, and plead, and let me explain. This picture is a picture of the Freedom Tower at Ground Zero. You can see that in the background. I know most of you are staring at the young supermodel, but the intent of this was to please get out and vote because of our American freedom and because of this generation that's coming behind us. And the decisions that we make on November the 8th will impact our freedoms and our future generations. So please get out and vote. At this point, I want to answer some questions. We have our new expert up here. For those of you who don't know, this is a young lady named Aaliyah Gunn. And Aaliyah is our resident expert. She'll be one in another about 10 days. And so she makes sure we have all the answers. So if anyone wants to type a question in, that would be great. The chat box is open. We have some submitted questions that I want to be sure to share with you. One of our submitted questions dealt with, what about gold and silver? Should we be looking at gold and silver for our investments? Well, traditionally, gold and silver have not returned very solidly for us over the years. It has been that, yes, there's been the growth, but generally they keep up with inflation, and that's about it. That question went on to do the doomsday side of gold and silver, and the fact that, oh, if I've got a gold coin and everything goes crazy, I can take that gold coin and I can barter it for something else. Well, maybe. I know when we went back through the COVID side of things, if you had a gold coin and Publix was closed, the grocery store was closed, you still couldn't get in and buy food. So you're into the barter system. A very astute financial advisor friend of mine says that in the event of a total catastrophe, there are two things you need to make sure you have lots of. One is bullets and the other is booze. You can barter the bullets and you can barter the booze and protect yourself with the bullets. I hope in our lifetimes we never get to experience those types of things, but those are out there. Another question we had was where to put your money now. And again, I'll go back to that slide I had a few minutes ago about what's your objective, what's your time frame. These are the keys that you have to look to determine what is going to be right for you. So sit with your advisor, talk about your objectives, talk about your time frame, talk about your risk tolerance, and look to see if there is a modification you should be doing in your portfolio at this time. But obviously, it can be a time to take advantage of some year-end tax planning. Don't miss those opportunities the next 2 months. Well, I don't see any additional chat questions, so I must have done a good job of covering things. I hope I did. A few disclosures for you. I hope you're leaving today with more treats and fewer tricks. To me, that's very important for you. Happy Halloween. If you know someone who would benefit from our webinar, we'll also be offering a recording of today's presentation on the Gunn & Company YouTube channel. Once it's posted, we will email you a link if you were registered today and present, obviously. Feel free to share it with family and friends. I don't see any final questions, just a heads up. As always, our next scheduled event will be our annual economic update, which will be held on Thursday, January 26, 2023. Wow, hard to believe, 10 a.m. I'm sure it will be interesting. So again, thank you for joining us. We look forward to meeting with you soon. Have a happy Halloween, and remember, please vote. That's our way of protecting America's future. Thank you so much. Have a great day.